Jamie, today on the podcast, we're going to talk about the LADS method of investing. Low cost, automatic, diversified, and simple.
Welcome to the Military Money Manual Podcast, where every episode is all about achieving financial independence in the military faster than before. We believe personal finance shouldn't be boring or intimidating. Building wealth can be simple, and financial freedom is the ultimate financial goal. Now, here's your hosts, Spencer and Jamie.
Hello, everyone. Welcome back to the Military Money Manual Podcast. I'm your host, Spencer Reese from militarymoneymanual.com, joined by my co-host, Jamie, in person, live in a recording studio in Honolulu, Hawaii. What a beautiful place. It's just magical.
It was great. We had some poke, and we're back in the studio after lunch now to talk about a concept that is original to Sir Spencer Reese here, Esquire. I will say, though, as a beta reader of your book, I think I helped rearrange the letters to make it into an acronym. Before it was like LSAD or something. It was like, dude, you got to rearrange this to make it LADS. So yes. Low cost, automatic, diversified, simple. Spencer, that is one of the key principles of the book when you wrote the Military Money Manual Podcast, and it makes it easy and approachable for people to understand what they should do with their money, which can sometimes be an overwhelming topic. So where do you want to start, with the L?
Yeah, well, I mean, we'll start from the top with the L, but in general, the LADS system is, it's in the title, it's simple, right? It doesn't tell you exactly what to invest in, but it gives you a framework. It gives you principles in which to work with. And I think these are the principles that I gathered from reading books like A Random Walk Down Wall Street, Simple Path to Wealth, The Little Book of Common Sense Investing by Jack Bogle. And it really emphasizes minimizing stress and decision fatigue, having a resilient portfolio that you can stick with through bull markets like we are experiencing right now in 2024, where the S&P 500 is up almost 25%, close to the end of the year here, or in bear markets like in 2022, where we saw a 22% decline in the US stock market. Morgan Housel, who wrote The Psychology of Money, has this great quote about how he can afford to be an average investor, but he can't afford to be a bad investor. And the LADS system is all about keeping you from being a bad investor by performance chasing, by adding complexity, by having high expense ratio funds, by relying on your willpower to make the right decision at the right time and to add emotions into the equation, and to concentrate your portfolio into, just a few investments that have a high likelihood of not performing better than you could in a simple low-cost index fund. So let's get into it. What can we not control? Let's start with that. You can't control performance. You can't control what the stock market's going to do, what the bond market's going to do. You can't control what the Fed is going to do, what interest rates are going to do. You can't control what Congress is going to do. You can't control when a war is going to start, when a war is going to end. You can't, even if you're in the military, like oftentimes you can't even control what your next assignment is going to be, or where you're going to live, or when you're going to get deployed, or what even your job is going to be. So we want to focus on what we can control and not stress about the things we can't control, which are all the things I just mentioned. But what can we control in investing? Well, we can control our asset allocation, right? We can control where we invest, what kind of assets we purchase. Do we want to buy cryptocurrency? Do we want to buy tips? Do we want to buy CDs? Do we want to buy certificates of deposit? Do we want to buy stocks or shares in companies? You can control costs, so you can keep your costs low, or you can get very expensive very quickly when it comes to investing. And people love to sell you expensive investments like whole life insurance that might not be wholly appropriate for your situation. Other things we can control are savings rate. We can control how much of our paycheck we're setting aside every month and investing. Our friend Jeremy Schneider from Personal Finance Club likes to say, there's only two rules in personal finance. It's spend less than you earn and invest early and often. And really, that's what it boils down to. And so the LADS method just takes it a little bit further than that. And it gives you a system that allows you to enrich yourself and enrich your community and enrich those whom you come into contact with throughout your life. So why do we focus on low-cost investments? Well, in general, most active managers cannot beat their index. So what does that mean? It sounds simple on its face. Like if you're an active manager, right, and you're presented with the S&P 500, wouldn't you just want to look at the different companies and the different stocks that are in the S&P 500? And why don't you just filter out like the worst one, like the one that has like no chance of outperforming the market in the next year? And then why don't you look at the second worst one and just start eliminating them, right? Like maybe if you just eliminated 10 of the worst performing stocks in the S&P 500, you could have a better return. Well, why don't you eliminate like the bottom 250, right? And you can keep narrowing it down. And if you were a genius stock picker, then maybe you just buy Monster Energy, right? Because that's the stock that's done the best over the last 20 or 30 years, up almost like 200,000%. Like it outperforms Amazon, it outperforms all these other companies. But it sounds simple, just don't buy the losers and focus more on buying the winners. But over a 10-year period, 87% of active managers who purchase S&P 500 shares can't beat the S&P 500 index. And over a 20-year period, 93% of those active managers can't.
Yeah, so even if they do get it right once or maybe 2 years, the chances of them beating the S&P 500 index year after year after year is almost impossible to do. And then for them to repeat that. So like your manager, if you pay someone to do it, they might beat it this year. Maybe they beat it next year. But 8 years from now, they're probably not going to be the 7% or the 13% or so that do beat the index. You're sacrificing a lot of your performance when they take out 5% front load fee, which is you contribute $1,000 or $10,000 or whatever, they automatically take 5% of that off. And so you're investing 5% less upfront. Then they charge a 1 or 1.25% fee for all of your assets under management each year. And it just crushes your returns, especially when you're early on, when your main gain is how much you can contribute to take out a percentage of that to fees and then compound that over time. It just crushes your future gains.
Yeah, you got to pick. I mean, so let's say that you're like, well, from what I'm hearing, Spencer, 7% of fund managers do manage to beat the S&P 500 over a 20-year period. And yeah, that's true. 7% do. But I don't know who that 7% is.
And it's not the same 7%.
It's not the same 7%. You got to pick them right now. And then you have to be able to stick with them for the next 20 years. And there'll be periods of time where they underperform the index. And is that the time that you bail? Hopefully not, because if they're the 7% they're going to outperform over the next 20 years, you want to stick with them for the next 20 years. But it's impossible to know in advance who those fund managers are going to be. And in fact, usually, I mean, we saw this most recently with Cathie Wood's, the ARK investment fund, where tons of money poured in during COVID, and that was right when she started having her worst performance. So she had a great period of outperformance, and then money started pouring in, and she had a period of, I think, like from the peak, they were down like 80% in the fund or something. And that's just right there. That's a perfect example of people chasing performance and trying to outperform the market. But it's really hard to do. So there's this great, the S&P, the Standard & Poor produces a score called the SPIVA, S-P-I-V-A scorecard. And you can go check it out. And they publish it every year. And they look at all the active fund managers and they see which ones outperform over a 20-year period. And in fact, a lot of mutual funds, active funds, they don't even survive a 20-year period. So a lot of them shut down and are no longer even trade. So imagine if you pick a fund that doesn't even make it 20 years, right? That they have to close the fund after a certain number of years just because either they're not performing or maybe the fund went to zero.
Spencer, when you say low cost, can you give us a framework for what? Because to some, a 1% fee might seem like low cost. It doesn't seem like a large percentage. What should we be looking at for something to be considered low cost?
Yeah, Jamie, like a 1% expense ratio on an account. And you can look at if you're buying an ETF, an exchange traded fund, or a mutual fund, you can take a look at it and look at what the expense ratio is. And that's a great way to compare funds. So you can see, okay, this fund costs this many percentage points a year. And so like, let's say you see a fund that's 1%, right? So that means for every $100 you have invested in that fund, they're going to take $1 every year from your returns or from your losses. So
whether it's up or down.
Exactly. Let's say you invested $500 a month for 40 years. How much will you pay in fees based on different fee structures? Well, if there's a 1% expense ratio on the fund over 40 years, you're paying $750,000 on that fund. If it's an even higher expense ratio, like let's say it's like a 6% transaction cost and a 2% expense ratio, you're paying $1.4 million over 40 years, just investing $500 a month for 40 years. Now, let's say on the other hand, though, you pick a very low cost index fund, like a Vanguard total stock market index fund, where you can, and some of these funds like Fidelity offers the FZROX fund, which is a 0% expense ratio fund. But all the Schwab, Vanguard, Fidelity ETFs that are in this space, they offer very, very low cost ETFs and index funds. And so, for example, like on a 0.04% expense ratio, again, the same scenario, $500 a month for 40 years, you're only paying $35,000 in fees. So you're saving from going from a 1% expense ratio fund to a 0.04% expense ratio fund, you're saving over $715,000.
Yes. So when we're looking at TSP funds, a lot of them are 0.05 or 0.06 expense ratio is still very low cost and Spencer approved, if you will, trademark that probably. Some of them at Vanguard or Fidelity might be 0.03 or lower, but that's not really where you're going to make a big difference. It's going to be the 0.03 or the 0.05 compared to the 1.25 or the 2% fee. So that's the delta that you're looking to try to avoid for the average military investor.
Yeah, it's crazy. I mean, some of these funds even at USAA, like they have an S&P 500 fund, and the expense ratio is like 0.5% on it, which is over 10 times the Vanguard equivalent VOO S&P 500 fund, which is like 0.03%. And they're invested in exactly the same thing, the 500 largest companies in America. And yet one fund is charging you 50 cents for every $100 that you have invested in the fund, and the other fund is charging you 3 cents. And those expense ratios add up substantially over time.
Okay, the second thing is the A in the LADS method, the automatic or automated investing. How are some ways that we can automate our finances and make it easier for building net worth without having to put so much time and energy behind it?
It comes down to humans are creatures of habit, right? And you want to create the environment in which you can succeed. And for most people, that's setting up automatic systems that take care of the heavy lifting of investing, and you don't have to get involved. So really, you're going to want to make the decision that removes 100 future decisions. And the easiest thing for military service members to do is at the beginning of the year, change your TSP contribution allocation to probably to the Roth TSP, as we talked in a recent episode about making Roth contributions. And that's it. You just need to set that once in MyPay to contribute to your Roth TSP. And if you're looking to max it out, I publish a chart every year that explains how much of your paycheck you need to contribute per month so that you max it out by the end of the year and receive your full 5% match. And Vanguard, in fact, Jamie, has a great program inside their Roth IRA account where depending on where you are in the year and how much you've already contributed to your Roth IRA, you can just say, hey, automatically pull money out of my checking account so that I max my Roth IRA by the end of the year. And it does all the calculation for you. So you don't have to worry about going over. You don't have to worry about under contributing. But if you can set up automatic systems that take care of your saving, investing, and remove the decision fatigue from you, then that just creates a much less stressful life. And you remove the emotion of investing too, because sometimes it's hard to put money to work in the stock market if it's had a big run up, right? If it's up 25%, you're thinking, oh my gosh, like the only thing that can go from here is down. But actually, in most years, if there's a good year the year before, the next year is an even better year, or at least a positive year. And so creating those automatic systems that allow you to keep your money invested and to keep contributing from your paycheck every month or every quarter, however you decide you want to set it up, those are the ways that you can easily build wealth without having to think about it.
So investing in my TSP, whether at 5% or more, that's an automated system I'm setting up. The military even does it automatically for me. If I try to turn it off, it'll turn it back on in January for automatic deduction straight from your paycheck. And then you mentioned the IRA. If you do your individual retirement arrangement or account at Vanguard or Fidelity or Schwab or whatever, you can set up both a automatic transfer from your checking account to your investment account, and then you can automatically buy the ETF inside of your account. So it's a two-step, both automatic process. You set up two automatic things, and then it removes that forever, and then you can continue. Whether you're maxing it out or not yet, you can do 50 a month or 100 a month or 500 a month or max it, whatever you set. But it just does it all automatically, so you don't have to worry about it. And the same can be true if you're maxing out both your TSP and your IRA and you have extra money, and it's going to maybe a kid's 529 plan or a taxable brokerage account. All of that can be done automatically as well. So you don't scare yourself out if you hear the sky is falling on the news. I shouldn't invest yet. I should hold my money. And then you miss two of the best days in stock market history because you don't know how to time the market, because no one does. So take the decision out of it. Just do it automatically. TSP, IRA, brokerage account, 529, whatever you're doing. Even in your budget, you can set up automatic transfers to move money around.
Let's say you have a auto insurance bill, right? And it's only due every 6 months, $600. Well, that's coming up due. So if it's in January, it's due in June or July. Have your USAA or Navy Federal, wherever you do your banking, have it pull $100 out of your checking account and put it into a designated savings account for that bill that you know that it's coming. Sinking funds is a term that you might hear in the personal finance space where you know that you have this large expense coming up. And so rather than taking care of it with that month's money, you take care of it with all the months leading up to it. And then it's not such a big deal when the bill does come. Just a quick note from one of our sponsors, and then we'll be right back to the show. Hey, Jamie, we got a lot of great people out there listening to the podcast. Any resources you'd like to point them to continue the education on financial independence in the military?
Yeah, if you're getting value out of this podcast, but you just want a little more detail or some more practical steps, you got to check out the Military Money Manual book by Spencer Reese, A Practical Guide to Financial Freedom. In here, Spencer laid out everything that he wished he had been told when he first joined the military, and it's going to help you build wealth and take advantage of your benefits while you're serving on active duty or in the reserves or in the Guard.
The Military Money Manual is available on Amazon, Audible, and my website, shop.militarymoneymanual.com in hardcover, paperback, ebook, Kindle, and audiobook. Podcast listeners are eligible for a special discount by using promo code PODCAST when you purchase the Military Money Manual on shop.militarymoneymanual.com.
All right, the third is the D, diversified. So diversification may be a confusing topic in general. The big thing that we're trying to get out here as you explain this is that we're not all in gold. We're not all in NVIDIA. We're not all in Apple or Microsoft stock. We have a sampling of a lot of things, whether it's different asset classes. It's not all American stock. It's not all, U.S. stock market and the home field bias that we've talked about in the past. You might get lucky if you pick one thing, right? But if you buy all of it, all of the stock market, then you have more of a likelihood of succeeding. And when stocks are down, bonds are usually doing better. So there's that balance there for diversifying, so you're not putting all your eggs in one basket.
Exactly right, Jamie. Diversification is really the only free lunch that we get in investing. Talk to anybody who had all their retirement savings in WorldCom or Enron or Lehman Brothers, right? All of those were very reputable, very respectable companies right up until they went bankrupt, and all of the people's savings that were in those companies evaporated overnight. Yeah. Let's say that you had owned bits of Enron through an index fund. You probably wouldn't even notice it in the overall scheme of the index fund because, let's take the Vanguard Total Stock Market Index, for example. There's over 3,000 American companies represented in that fund. When I was growing up, my dad always told me diversify. Well, at the time, it was harder, right? Like you had to go buy a couple companies. SPY, the S&P 500 ETF from Spider Funds, that was available. But looking at all the ETFs that are available today, there was no way you had that level of diversification that you can purchase now. It's so easy now. I mean, you can go out and buy a single ETF, VT, Victor Tango. It's the Vanguard Total World Fund. And it has about 60% US companies in it, 40% global companies. There's over 9,000 publicly traded companies represented by that fund. 9,000. So in fact, it's almost 10,000. And if you think about that, right, like you have just spread your eggs across all the baskets in the world, right? You're not invested in a single stock. You're not invested in small cap, mid cap, large cap. No, you own all the caps. You're not in a single country. You're all over the globe. Can the value of the investment still go down? Absolutely. And it will. I guarantee you there will be bad years where the value of the investment goes down. But over the long term, if you have any optimism, and I think you should, about the future of humanity, the chart is up and to the right. Right? Humanity likes to solve problems, likes to solve really hard problems and continue to grow and to continue to return or accrue wealth to those who own businesses, because that's what you're really doing, right? People get all caught up in, should I buy this fund or that fund? And at the end of the day, if you're buying a broadly diversified stock, international or domestic stock market index fund with thousands of companies in it, you have to realize that you're buying little pieces of Microsoft, little pieces of ownership of Apple, and these giant companies, all the people that work for them and all the billions of dollars that they make, you get a small portion of that. Some of that value is going to return to you either through the forms of dividends or through appreciation of the share price.
Yeah, I don't think people realize that, especially beginner investors, what it truly means to buy a stock market index fund, S&P 500 or total stock market index fund. When you're talking about buying a portion of 500 companies or a portion of 3,800 or so companies, for the total stock market, U.S. stock market, you're actually becoming a partial shareholder or a full shareholder or owning multiple shares of these companies, like the big names you just listed. And so what that means is like you might have voting privileges in some of their shareholder meetings. You maybe get access to profit statements and not insider information in the sense of like illegal trading, but you get a peek behind the curtain of their strategy and the benefits that are coming to their consumers over the next quarter because they're trying to drum up excitement for their business so it attracts more investors so they get more in so they can make more customers. And when you buy S&P 500 or total stock market fund, you are literally becoming an owner of some of these massive companies. Now, granted, some of them are a very small portion of a share, but not all of them are small portions. And depending on how much you invest, eventually you might be a legitimate shareholder. Yeah. And that's pretty cool.
Yeah. And, a lot of times people get confused and they think the TSP is somehow like separated from the US market or the global market, and that like the TSP funds don't represent index funds and don't represent companies. And it's like, no, go look at the holdings in the C fund. It's the 500 largest companies in America. It is literally the S&P 500. So you could go out to a brokerage account and you can buy VOO or SPY. People love to, trade options on them in Robinhood or whatever. But you could also just go and buy that fund in your TSP with your contributions that you did through MyPay, hopefully to your Roth TSP. And you gain access to the 500 largest companies in America, which have had a annualized 10% return for over the last 100 years before inflation, but that results in almost a 7% real return over the last 100 years. And if you plug those numbers into a compounding interest calculator, and whether you want to do it in today's dollars or in future dollars, I mean, if you use 10%, it turns into monopoly money really quick if you're making any kind of substantial contributions. I mean, Jamie, we've run some of those numbers where we're like, oh, if we live to be 100, like it's almost an inevitability that we're going to be millionaires.
Yeah, it becomes silly at some point for sure. The last one is simple. And I think we probably have some listeners, maybe they're newer listeners or they're beginners. They haven't gotten started yet and they're just scoping out the personal finance space. Mm-hmm. And probably to them, none of what we've talked about so far seems simple or easy to understand. What's my next way forward? But there is a path that you lay out in the book and that we can explain here about how personal finance and investing can be simple with setting up the simple automated systems you talked about and a strategy that is simple. It doesn't have to feel overwhelming for the military families. Yeah.
I mean, I like to tell people that managing my portfolio, which again, like I own over 9,000 companies, right? And do you know how much time I spend a year managing my portfolio? About 5 minutes. That's it. Every year in May, I add up how much US exposure I have, how much international exposure I have, how much cash I have, and how much bonds I have. And I just make sure it's close to my asset allocation plan. And if it's not, I rebalance a little bit. And that could be as simple as, okay, next time I go to purchase shares, I'm just going to purchase shares in the class that I own. I don't own enough in. Or it might be I'll trade a little bit inside my Roth IRA account, so I'm not on the hook for capital gains. But yeah, complexity in finances never beats simplicity. I mean, it might in the short run, and it might for traders or finance people who like do this stuff for a living. But on a personal finance level, complexity never beats simplicity. Simplicity is going to win every time. You want to create a plan, a simple plan that you can stick through both bear and bull markets, and you should be able to really explain your investment strategy to your grandmother. Or like an older child, like a teenager should be able to quickly grasp what your investment strategy is. And I'm not saying you have to go out there and do it, but if you start using like Greek letters, alpha and beta, and start talking about Sharpe ratios, you pull out the spreadsheet. And if you're someone who's using Projection Lab, which we do love Projection Lab, if it requires a finance degree to understand what your overall investing strategy is, I think you need to simplify. I think you need to make it a lot less complex. And I see new investors have this tendency to just like, oh, I'm going to open up an account here. Oh, no, open up an account there. And before you know it, they have like 7 bank accounts at different banks. They have a Robinhood account, a Schwab account, a Fidelity account, and it just multiplies and multiplies. And they have $1 here, $1 there. It's like, come on, that's way too complex. Keep it simple. Stick to one of the major brokerages, at least when you're at the start. And you should be able to basically keep track of your entire portfolio in the back of a napkin. And if you can't, it's probably a little bit too complex. And as you grow more wealthy, there's going to be this pull towards complexity because you're going to think, oh, I should be doing more things, right? And Jack Bogle, or maybe it's Warren Buffett, has the quote like, don't just do something, stand there. It's so true in investing. Like really, the more you do, the more you trade, the more friction you add to the system. As on a personal level, on a personal finance level, the harder it is to actually make any additional money from all that activity. It's really the optimal scenario is put the money in and don't check it for a couple of years and just set up these automated systems, and you will be amazed how quickly compounding interest goes to work. And the numbers, I mean, Jamie and I both paid off over 6 figures in debt when we were early on. It's amazing how quickly you get that first 100,000 and then the next 100,000, how much faster it comes, and then the next and then the next. And it grows rapidly to the point where if I was to tell my 20-year-old self what my net worth is today, I wouldn't believe them. Right?
Yeah.
Could I be like, the math doesn't math. And I'm like, no, it does.
I don't feel like the first 100,000 was quick, but after the first 100,000, it started to roll. Compound interest took over for sure. The test I like for the simple is, if I were to deploy short notice or, get in an accident where I'm in a coma for 6 months, like would my family be able to take over the system? As the nerd in the relationship, could my wife adopt this system? Well, almost all of our stuff is automated, so it would all happen. She wouldn't have to inject anything. And if your system can't recover, especially for a military family, if it can't continue, if the primary money nerd deploys or gets injured or God forbid passes away and the system falls apart because you're in there manipulating stuff personally every other day or every week, then it's probably more complicated than the average person needs. So keep that in mind too, is what are you leaving behind for your spouse, for your kids, for your parents, should you pass? What kind of complexities are built into there that you maybe don't want to pass on this hyper complicated tax bomb, this very intricate tax situation, 19 different accounts for them to have to send death certificates to. All of those things are considerations that you have to make. And as much as we don't like to think about it or say it, like you could deploy tomorrow and be gone for 12, 15 months or forever.
Without internet connection.
Without internet connection, with no notice and no time to go update your will or to remind your spouse where all the account passwords are. Like you have to be prepared for that, especially as we move into increasing political tensions. You never know where the world's going.
And not only that with the investing accounts, but your credit cards should be on auto pay, right? Like you should be able to step away from your whatever the financial system you've set up. If you can't step away for like 2 credit card billing cycles and it all falls apart, if you step away, it's too complicated. Like you need to automate it. You need to set this up that you can remove the human in the loop and the system just keeps running. Your rent is paid on time. Your credit card bills are paid on time. Your utilities are paid. Everything. And that gets back to, the automation, but also it includes the simplicity too. And so the LAD system doesn't just apply to investing. It also applies to just your entire personal finance universe that you're trying to create. And like you said, Jamie, like you should be able to, on like a 1-page document, essentially, you should be able, and that's a great thing to if you are the money nerd in your family, you should produce that document so that if you do get that deployment, you can just say, honey, read this. Let me know if you have any questions. I'm going out the door tomorrow, and everything should be set up that it can keep running even without your intervention, but this is how it works.
Yeah, hopefully you even have that conversation before the short notice deployment. Take the time to be able to ask questions before you go.
Just a quick note from one of our sponsors, and then we'll be right back to the show.
It's no secret Spencer and I are both huge fans of the Thrift Saving Plan, the military's version of the 401k retirement plan. We've both been investing in the TSP for over 14 years and are thrilled to announce we've consolidated all the information you need to know into a new course called the Confident TSP Investing Course.
That's right. The course is a comprehensive guide to navigating the TSP, breaking it down to easy, bite-sized chunks that lay out the basics of the thrift savings plan, the funds available, and the investing strategies so you can build wealth while you serve.
We both know what it's like to be a beginner and to be overwhelmed with all the information that's out there about investing in the TSP. Head over to militarymoneymanual.com/TSP, Tango Sierra Papa, to find our simple breakdown of all you need to know. You get lifetime access, and we'll have a growing library of content. And one of my favorite parts about the course is that for every course we sell, we're going to be donating one to an E4 or below.
Yeah, I love that feature of the course, Jamie. So if you're an officer, an NCO, a senior NCO out there, and you purchase a course, first of all, thank you. And also know that you're helping a fellow service member, a sailor, a soldier, a Marine, an airman, a guardian, a Coast Guardsman, E4 or below, take one step closer to their financial success.
The link's in the show notes, or head over to militarymoneymanual.com/TSP, where you can sign up for the Confident TSP Investing course. Now, back to the show. There's so much noise out there in the personal finance space. And that's one of the things that I love the most about how you broke this down. Not to toot your horn, but if you follow these 4 principles, it will work. It will succeed. Now, could someone beat you this year? Yeah, maybe they will. Would they beat you again next year? I don't know. Maybe. Will they beat you 5 years from now? I don't know. Maybe. But low cost, automatic, diversified, simple. If you implement these strategies, you will see your net worth grow. And just like anything, sometimes sticking to a system that works, like it's like you want to get better at you're doing your PT test. Sometimes simple workouts of your chest strength for push-ups and running for your running time and core exercise for your sit-ups. It doesn't have to be very complicated.
No, it doesn't.
But people will sell you a very complicated method. You might see an Instagram trainer or someone out there that's saying like, you have to do this. Otherwise, you're going to be terrible. And there's a path to do things in an easy and simple to understand way. And one of the ways to do that is continue to ingest knowledge from podcasts, books, blogs that you trust that have good information. They're not trying to sell you anything. There's no angle there for, trying to sell index whole life insurance, things like that. So
Jack Bogle shared a great chart. I can't remember what presentation it was, but you can Google it. But it was comparing the stock market returns, the average equity fund, mutual fund returns, and the average equity fund investor returns. So this is from 1984 to 2004, 20-year period. So the average stock market returns over that 20-year period was 13%. It was a pretty good 20-year period. The average fund returns were 10%. Okay, so a little bit less, minus some fees in there and probably some trying to do some market timing. But the average investor returns were 6.6%. So the average investor returns were less than half of what the stock market had returned. So again, if you had just purchased an S&P 500 low-cost index fund, you would have captured that 13% return, and you would have beat not just the bottom 50% of investors. You would have been in the top quartile of all investors just because you were willing to accept the quote-unquote average market return. Because the crazy thing is, and this is explained more in the little book of Common Sense Investing, but the returns of all market participants must be the average return minus fees, right? That's just if this guy lost 100% of his money and this guy made 1,000% return, right? You just add them up, divided by 2, boom, that's the average return, which you capture with an index fund, right? That's the crazy thing. And if you can do that at very low cost, sure, some people are going to beat you, but they're playing a completely different game. People get obsessed with outperformance and alpha and beating the market. Why do you need to beat the market? Why can't you just accept the market returns? Is 10% a year not good enough for you? Are you not entertained? It's crazy to me that amateur investors try to beat the market when there's this low-hanging fruit of low-cost, broadly diversified, cheap index funds available. And if 90% of your portfolio is in that, and then you want to gamble with 10%, okay, that's fine. But really, I would just advise 100% of your real money, your serious money, be invested in index funds and just capture the average market return. And you'll be far better off in 10, 20, 30, 40 years.
It's funny to me, there's 2 camps of people that are naysayers on this strategy. One will be like, I can never invest $100 a month. I can never find it anywhere. $1 million is never enough for retirement. $500 a month is not going to be enough. $5 million is never going to be enough. And a lot of times what you have is people that are just afraid to commit or to start investing. So they make up excuses of $100 a month isn't going to do anything, or I can't make it work, or it'll never be enough in retirement, so why even start? But if you just accepted the average returns, you're going to be better off than where you were before you started investing.
Right.
It doesn't have to be complicated. It can be diversified. You can buy the entire U.S. stock market. You can buy an international index fund and get an international exposure. And it doesn't necessarily need to be something that you are an expert at right away, because that's how simple it is.
Yeah.
And if you need help in the beginning, there's help out there. That doesn't necessarily mean it has to come with a high fee.
Right.
It doesn't have to be a bank that's going to also sell you, from a quote unquote financial advisor, also sell you a life insurance policy. There's free help available on base on post.
Yep.
There's the Military Financial Advisors Association. There's the Nectarine hourly fee structure at hellonectarine.com that we've talked about before. So it doesn't have to be a high fee structure, even if you need some help getting started or getting, the first couple months done.
For a military service member, Jamie, the easiest way to start implementing the LADS method of investing is your TSP.
Yeah.
It's right there. It is, and it has 5 fund options, literally just 5 options, and the life cycle funds, which are made up of the 5 funds. And we go into depth with this. You can go to militarymoneymanual.com/TSP, and we've got our TSP in course there, and it's free if you're an E4 or below. Check that out. And then podcast 24 is our promo code, and we'll probably have a podcast 25 depending on when this episode comes out. But you can use that for a great discount off the course if you want to take that and learn more about the TSP. Or just go to tsp.gov. They have some great material on there. And for 90% plus of U.S. military service members, if you don't want to create your own asset allocation, you're like, I don't know what I'm doing, that's a great position to be in. And they have a fund for you, and it's called the Life Cycle Fund. And in fact, it's the default option for all Blooded Retirement System, BRS, participants for the last couple of years has been defaulted. You're defaulted into the Life Cycle Fund, appropriate. So it's your birth year plus 60.
That's another great example. People are like, oh, I can beat the Life Cycle Fund. But like, you can. However, a lot of people are afraid to invest because they don't know where to start.
Yeah.
And so by you saying that Life Cycle funds suck or they're not good enough, you're prohibiting people that need to get started, and the Life Cycle Fund might be a perfect venue for them, maybe for 5 years, 10 years. It's like 17 years before the Life Cycle Fund starts very, very slowly going towards a more conservative. And as you dig in and you learn more about investing, your personal investment philosophy might be, I don't want that much international exposure or something like that. That's fine. Make a decision based on your information, but don't just shame people away from investing because you think that you can beat the market with one of your gimmicks that's going to overcomplicate your situation.
Yeah. I mean, when people, you see it on social media all the time, they're like, oh, 100% C fund, always 100% C fund. And it's like, well, what about the S fund? Like, small caps have beaten large caps in some years. You just want to completely ignore all the small cap companies. And here's a great example, right? Everybody's so hot on Tesla at the moment. Where was Tesla before it was in the C fund? It was in the S fund. So you could have owned Tesla inside your TSP by owning the S fund. And then when it got big enough that it was added to the S&P 500, you would still own it, but you would catch all that growth on the way up because you owned the S fund and the C fund. And so then it's like, well, do you want to ignore all those great international companies too? And they're like, yeah, look at the international performance versus US performance. I'm like, true for the last couple of years, but there's this thing called mean reversion. And if you look beyond the last 14 years or so, there's been plenty of periods of time where international stocks have crushed US stocks. And if you think this time's different, okay, that's your investment thesis. Go ahead and invest that way. But even the TSP board, if you look at how the life cycle funds are set up, they've recommended that a good chunk of the life cycle funds, especially early in your career, be invested in international shares.
Yeah, that thing you mentioned about Tesla, Spencer, is good because sometimes with this simple strategy, I feel personally, I'm sure others relate to this, is that I'm missing out on something because I'm not like doing something with my hands. Like, I don't know what to do with my hands. Everyone else is doing something with their hands, and I'm just like sitting there. And I'm like, well, man, I wish I would have caught the NVIDIA on the way up. It's like, no, I did.
You did.
I had it.
Yes.
In the index fund.
Yes, you did.
Through multiple accounts, both in my TSP and my IRA and my traditional brokerage accounts and each of my kids' 529 plans. Mm-hmm. Like, we had it everywhere.
Yep.
I wish I would have caught Tesla on the way up. We did. I wish I would have caught Meta when it went up 50%.
You did.
I did.
Yeah.
And it's a very good reminder to hear that and to say it out loud because it's not catchy. It's not cool. It doesn't catch your eye as you're scrolling through Instagram or TikTok because you just kind of set it and forget it, like the old infomercial with the microwave.
Yeah,
but it's like set it and forget it. Like, that is the ultimate investing strategy for me.
Yeah.
But I have to remember that I'm not missing out on stuff. I'm getting everything all at the same time.
Yeah, it's a very Zen-like state of investing because you're literally just sitting there in the lotus position doing nothing, and yet you're doing everything, right? Because the passive index fund, and like as soon as a new company IPOs, right, after a certain period of time, it's added to the index. And, let's say it's the next Tesla or whatever, and if you own the Vanguard Total Stock Market Index Fund, you will own a small percentage of your capital will be allocated to that fund, and you're going to ride it all the way up. Like, NVIDIA went from not even being in the S&P 500 to being the largest market cap company in the world. In fact, it's only $1 trillion less The market cap of NVIDIA is like 3.5 trillion at the time of this recording. And the entire Japanese stock market, which is the second largest stock market in the world, is 4.5 trillion. So it's like we almost have a US company larger than the entire stock market of the second largest stock market in the world. What do you do with all that information? Well, the great thing is you keep it LADs, right? You keep it low cost, automatic, diversified, simple. Like you said, Jamie, if you get FOMO, if you get the fear of missing out because you're like, oh, I should have been in NVIDIA. Oh, I should have been in this. When you have the index, you did. You were in there. You were in there from the beginning. And I think it's important to remind yourself that, yes, I wish some small portion of my portfolio had been over allocated to those shares, but you probably thought about that about other stocks that have gone absolutely nowhere or have gone down.
Yeah.
I'd like to say I'm like the world's worst stock trader because every
It's
time
true.
it is. Every time I'm looking at buying something, guarantee as soon as I buy it, it's going to go down in value. And a couple of years later, I'm going to get bored of it and sell it. And then it's going to rocket right up, way outperform the market. And I'm going to be kicking myself. And it's a great reminder to me when I do play with a little bit of my side money. I'm not very good at this, but I don't have to be. I can just use the LADS method and keep it simple.
Thanks so much for tuning in to this episode of the Military Money Manual podcast. If you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This helps others find the show, and we really appreciate it. Thanks again for tuning in, and we'll catch you in the next episode.
The views and opinions presented here are those of the speakers and do not necessarily represent the views of the DoD or its components. Reference to any commercial products or services does not constitute DoD endorsement of those products or services.